Chart watchers and Decision Point faithful. Welcome to this May 9th, 2022 Decision Point Show. My name is Erin Swenlin from DecisionPoint.com, and I am here with my father, Carl Swenlin, and we're here to show you the charts that we think are the most important moving forward into this week and honestly beyond. With this bear market, I know lots of people are watching and listening, so welcome to the show. Dad, how are you doing?
Good. Enjoying this downturn.
Enjoying it?
Well, it's like I'm right.
It's been a long time coming as far as this bear market developing. And, we've been kind of on top of it since the downturn. So we're pretty proud of that fact for sure. All right, so let's go ahead and we're going to look at our agenda. We're going to actually start off talking a little bit about sentiment. This is actually starting to become a news item about bearish sentiment versus bullish sentiment and what that could mean for a bear market. We're going to do Carl's grab bag. I know you had a few subjects you wanted to cover, Dad, before we get into our indicator overview. I'm going to talk a little bit about all of the different indexes. We'll look at some of those major charts and determine what the next levels of support truly are as far as stronger support levels. So we'll look at a couple of those charts. I was asked this morning in my free trading room about just this question. So I think that it's a good one to cover. And then I will finish with some diamonds in the rough. And I present 10 diamonds in the rough every week for my Decision Point Diamond subscribers. So I'll give you a little bit of a taste of that. One of them is a pick that we had last week. And another one is one that looks interesting as a short. So we'll talk about those later. Before we get into that, though, let's look at the Decision Point scoreboards. So here we determine what our intermediate term trend model and long-term trend model signals are. A long-term trend model signal is simply developed by a 50 to 100-day upside crossover or golden cross. That'll give you the buy, or a death cross, which
not up to date.
Oh, no. Well, there we go. So anyway, that's kind of where we're going with this. I think you're right, because I know there are a lot of red on this chart. I don't know where I got this one from.
I believe it's all red now.
So, all red.
Yeah.
Okay. And this was just today. So I know this one is correct. But right now, the only areas of the market really are those more defensive areas, consumer staples, utilities, and then, of course, energy has still been pretty much the outperformer moving forward. We still think it looks pretty good, but we'll look at those oil charts and some of those others shortly. Let's go ahead and get on started with all of this. So I'm going to pass the screen to you.
Okie doke. And we're starting out with the AAII sentiment chart. The basic readings are here, bulls and bears. This is the bulls divided by bears. And I picked this one up from Martin Pring's article this weekend, but he keeps this chart a simple moving average, 4-week moving average, and of bulls. And I just added this one and just tried it with the bears to see what it would look like. The thing is, people think, and it's true generally, that when you get low readings, or should we say high readings of bears or bulls, it's time to start taking or considering taking the opposite view. When you get too many bulls or too many bears, this is just basically they're going to be wrong most likely. But so we've had really a very low, high reading, should say, of bears, and one of the highest readings in this is the history of the indicators, and you can see that generally speaking, when you get those kind of readings, you get rallies. But then you look at this, at the financial crisis in here, and you just had them one right after another all the way down. So that was not helpful. And I say right now, okay, look for reversals, but I don't think we're going to reverse up out of this and have a brand new bull market. But we could have, obviously, a rally of some type. That notice here in 1990, we had a really, that's the second lowest reading on the chart. And that was because there was a lot of anxiety about entering Desert Storm operation. And I don't have the chart handy, but gold rallied quite a bit, and people were really bearish about the market because they didn't know how this was all going to turn out. They had tens of thousands of body bags in place over there. As it turned out, it was not a problem at all. And market rallied as soon as we knew that, and their gold went back down, and so it did give us a good turning point here on that particular one. And also we got a good bottom reading in 2003 after the .com crash. So anything to add to that?
Yeah, I'm going to go ahead and show our Rydex ratio chart. I haven't looked at this one in quite a while, admittedly, but now that we're talking about sentiment, one of the things that we're looking for at the end of a bear market is capitulation. Once all of the money's out there, all of the retail traders have been shaken out, most people have then moved to cash or are starting to really play those inverse ETFs, the bear funds. So this is a really interesting, and you can discuss the Rydex name a little bit more, but these funds are now managed by Guggenheim, but they were a group of funds run by Rydex, was the name of it. And they're closed-ended in that you have a kind of this universe of the bear funds versus the bull and sector funds. And then we also can track the money market fund for this Rydex. Now, because of the changes, this hasn't been as great of an indicator as it could be because of just all of the other inverses and everything out there now. But it still gives us a pretty good idea of what's going on. So what I'm pointing out here, as far as what we're saying about capitulation, is the fact that, we've started to see with this bear market, money leaving the bull funds and sector funds and moving into cash more than these bear funds. Now, we had some spikes here. I'm not really sure what that is about. But in any case, the point is that for a while, we really weren't seeing much going into those bear funds. When we start to see a lot of money floating in there as well as out into cash, that's when we're really starting to see that capitulation in the market. I haven't been seeing it. This is recent, seeing these bear funds now slowly starting to gain some momentum. So we still have more that we can experience. And if I take this out to a longer term here, let's just make it I'll make it some 10 years here. You can see that this level on these bear funds is not a lot in comparison to what we were seeing even just back in 2015 and 2016. So we're talking about, we really need to see some capitulation here on a much larger scale, but everybody is starting to become very bearish. And when that happens, as you were saying, Dad, you end up seeing everybody jumping on that bandwagon and then the wheel starts to fall off. So you've got to get everybody there, though, before you can really count on sentiment to be giving you the kind of information you need.
The spikes you see are generally, this is not a lot of money in these funds. Mm-hmm. And my experience was usually a single investor or trader dumping a lot of money in at one time. So that's probably where that came from.
Okay. But yeah, just looking in, at that historic levels, we're not really there. We could certainly see much higher readings. And, we're seeing that run out of those bull and sector funds. Well, we can see that just in price right now. But this is interesting to look under the surface and see these. But I'm going to pass it back to you because I know you have your grab bag and we still have to look at all those indicators.
Okay. Before I move along, I wanted to mention the Malden newsletter, weekly newsletter. It's free at maldeneconomics.com. And it's a regular read for me, and I recommend it. I'm not getting any money out of a recommendation, so if you're wondering about that. But the last week was an item in there talking about recessions. Normally follow food and fuel spikes, which of course we're getting. Cost of food and fuel is just going through the roof, and so we're looking. Of course, that is one thing that could tell us that recession's coming, and God knows there's a lot of other stuff out there. But also, if the comment was that the recession will, and those spikes will stop inflation. I don't think it means overnight, but that is something good we can look forward to possibly. We shall see. Just something I wanted to pass along. Okay. I wanted to do a little work with long-term charts. We look at I look at a one-year chart all the time, but in this situation, I want to look further out, see what's going on. Right now, well, you got a rising trend here that's been broken to the sideways, but I think eventually we're going to see this line of support break not too far from now. Let's look at the other. These are FAANG stocks, and we can see they're not doing well at all. Adobe down 47%. Again, looking at the long-term chart, this is a very big top here. And again, there was support right in this area. That's long gone now. The next level would be right about where it is now.
Yeah, it looks like it's already broken.
Yes, you're right. It has. It's a little lower than that. I should probably have my, yes, there you go. Yes, it's below there. Amazon, this is amazing to me. This, bulletproof stock just a few months ago, and it's down 42% now. And again, we broke this support that I set earlier this morning. In the weekly, this is awful looking. You got a broad top here, almost you could say rounded top. It's broken down by any support you want to find in this area. The next clear support, and there's a little bit in this zone. Oh, it's through that.
Yep. Again, another one.
There's a right here, yeah, and it's below that. So I would be looking for support into here, but this is a big bad bear market, probably the worst we will see since the 1929-32 crash. And looking at the PE, well, let's say the earnings, look at going down to 10 times earnings. Maybe not, maybe 20 times, but right now that's so far away, it's unbelievable. So we're looking at, it's not even on the chart for 10 times. 20 times would be around this area. So this is probably not going to hold. Well, maybe here, but, using the PE, that's what I would look for. Native platforms, again, looks horrible. Look at the weekly chart. Huge top, and now you can look for some support in here. Again, this is 10 times earning would be 150. So that's at least on the chart. Google, it's down 26. It's in a bear market. And looking at, yeah, this is horrible looking. Just, it's just a major top. And we're looking, I would be looking for support around this area. These are not predictions. It's just my opinion of what we should be looking for here. There's so many things wrong now. It just blows my mind. Microsoft, it broke down through this support today. So let's look at the weekly. Yep, major top. Again, maybe this area will see some support. Again, use your PE. 20 times would be 270. We're already down there, so we need. So I'm sorry, that's would be 95. 10 times is 95. So 200 would be. That looks like a good spot. That's 20 times earning right there. Netflix. You can just tell what this is going to look like.
Unbelievable.
Yeah. Let's even go to the monthly with that, see what we've got. Yeah. Probably this area. I don't see how they're going to pull it out overnight. They've got all this dead content on there they got to, that's got to be covered up with some good content. And they haven't started in that direction yet. NVIDIA, the largest chip maker in the world. And it's down, it's down 50% now, I would guess. There's the weekly. Horrible chart.
Yeah. And last week I had people asking me about buying it at that level that it was at last week. So at 180. And I pulled up the weekly chart. I mean, it just is, it tells the story. The indicators alone tell the story.
Yeah, let's look at a monthly. No different, no different really, just more compressed. But yeah, that people out there are going to say, some people are going to say using a PE of 10 as a possible support area is just totally off the wall for tech stocks. But this is not a good period for tech stocks. Even though they're great companies, it's still not a good time. Now let's look at Tesla. Let's go to the weekly. Yeah.
550.
Lower. I don't know. It just, I think, let's not get too deep into that. But anyway, you can look, you get a much better view of the longer term when you get to these longer term charts. I guess my guesstimate is about maybe half the people use them on a regular basis. I just think it's a good recommendation to use them. One final chart I wanted to go to. I had another chart here, and for the show, I showed this one last week, but definitely you can see from this is how many years is that? 84 to
40.
That's like 40 years, over 40 years. But so we've had a 40-year uptrend, and I think now we're going to have a multi-decade downtrend. It's all going to wash itself out over time. And you see here again that another month going in on the breakdown here. And with that, I will turn it over to you.
All right. We can look at just a few of our indicators. But before we do that, I did want to just give you kind of an update on the sectors with my sector candle glance. So Friday, the only sector with rising momentum was at the time energy, XLE, and it was one of the few that had, pretty good participation. But this is just a great example of what can happen in a bear market. We saw just a vortex suck of all of the stocks. Staples kind of managed to close on the negative side, but only by a slight bit. But everything else was really sucked down the vortex of the bear market. And this is going to probably be the norm. So thinking that you're going to be able to hide a lot of times, we used to say gold, people would hide over in gold or in bonds, as we were saying. There was talk of Bitcoin. It really isn't going to matter a whole lot because the majority of stocks are going to get sucked down. And I'm sure that you could probably, that you might agree with that. All right, so let's go ahead. Let me look at Bitcoin for you. I was giving kudos because I told everybody I was looking for Bitcoin at 32,000. We're below that. The level of support, I was really looking at 32.5 as a possible area where we might get some consolidation. But really, again, the negativity out there, that bearish bias has, Bitcoin has not been able to survive that either. And you can see that the indicators are still looking very, very negative for Bitcoin. And as with so many daily charts right now, Dad, we have to go to a weekly to even be able to find where the support levels are. And if we come back here, you can see the 2021 back here is probably the next level of support, which is,
Not very far away.
About 9%, which isn't that far right here to this support level with the way Bitcoin travels. But the actual support level, I would say the strongest support level is going to be in this area. And that would mean at a minimum, if we're going to this level, a minimum of a 40% breakdown further for Bitcoin. So not looking too good there. Oil, we were talking about energy. So I think it's a good idea to talk a little bit about what's going on here with USO. And as you can see, we've got the symmetrical triangle formation, although with this latest top, it's more of an ascending triangle formation. We're just unfortunately on the downside part where it's going to test that 50 and this rising bottoms trend line. But this is a bullish pattern. And, I know I've been expecting an upside breakout, but now we have the PMO has been very damaged, turning down below the signal line. But stochastic's still really holding in positive territory. And RSI is at the lower end of the range we've seen, but it makes sense on a pullback of this magnitude. Let's look at our trading oscillators here. We have about 6 minutes. So I'm watching because I want to go through just a little bit more info. So our short-term indicators, most of the indicators at this point are turning down and moving lower. Swenlin trading oscillators are no different. You can see our ITBM and ITVM also trending lower. This is where what we're talking about, though, is the big problem. So right now we have 25% of the S&P 500 with buy signals. That means they're on a buy signal. That does not mean they have rising momentum. We go back here to see how many have rising momentum. We do still see 27% with rising momentum, which is, still a paltry number, very, very low, not good. But I think the point is that we could get much lower and that we have seen much lower.
They still need to update for today on those.
Yeah. So these are our Swenlin trading oscillators, ITBM. And again, so the Swenlin trading oscillators certainly nowhere near oversold territory. And even the ITBM and ITVM are getting near those lows from January. But if we take this out, these are the levels we saw at the end of 2020. So we're nowhere near those. We are not oversold at all in comparison. So again, there's still so much more that could be absorbed by these indicators with a move moving even lower. So now let's just go look. I'm going through our golden and silver cross charts. I'm not going to discuss much down here. Like Carl said, we don't have these updated yet for price above their 20, 50, and 200. You can see what's going on with our golden and silver crosses, but the main thing I wanted to do was go through, and similar to what Carl did with those FAANG stocks, is just look, where's the next strength? You know, where might we find some support here? So on the Dow, the diamonds, 12%, another 11 or 12% before we hit strong support. Doesn't mean it'll hold it, but that just gives us kind of an idea of what we should be looking for as a possible finish. We can see that the NASDAQ, of course, has already been losing this support. The next level would come down similarly to the 2020 high. That's another 17% lower. The Dow 30, okay, we just did that one. Let's look at well, we've talked a lot about the S&P 500, so we'll just go right on over here to the S&P 400. This is the ETF, but again, to that 2020 high, we're looking at least another 14% to the downside. For the S&P 600, we're looking at another 14% decline. Basically, what I'm trying to show you is that, number one, those indicators are not oversold in respect with a bear market, and that support levels all of these strong support levels have now been broken. And so we have to go to the next support levels, and they are at the 2020 highs. And those are still fairly far away and would mean at least, 13, 14, 20% declines on top of what we're already have experienced. So hang on tight. And with that, I do have two diamonds of the week. The first one was one that I gave out last week on Thursday, and that was a short of the QQQ. And it is a juiced inverse ETF, so keep that in mind. What I told my diamond subscribers is maybe consider taking only 1/3 of a normal position that you might take in something like this if it were just a regular inverse, something to kind of lower that exposure. At the time, we were not worrying about it necessarily, but we knew overhead resistance was nearby. And I did set a really deep stop because, again, if you're on one of these ultras, you have to be prepared for 3 times your stop levels, 3 times, your upside targets. So when I was looking at this, we had to have a very deep stop level, but obviously not at all in danger currently. And with the breakout on this one, it's just starting to look even better. And then the other one came up today, and that was a short position on Dell. And I came up with this from my Diamond Dog PMO scan, and it basically does the opposite of my diamond scan. You can see the RSI negative. And again, it's one of those ones where you can't even find support. So we go to a weekly chart. And so my downside target on this short would be, you could look at another 20%, 15%. That's all we have for you right now on the Decision Point Show. Happy trading, good luck, and good trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.